All right. Well, so obviously we've got lots of going on in the world today, and over the last several weeks. So we've been talking to lots of people. Many are worried, concerned, and even scared about what lies ahead. I almost feel bad about saying this, but our business is thriving right now. In these uncertain times, when people are scared, when people are losing their jobs, our business thrives. Now, I'm in the risk management business. In times like this, people find themselves taking more risk and then they realize that maybe their plan isn't doing what they thought it would do. So we help our clients understand the appropriate amount of risk that's right for them. We help our clients with safe money solutions as well as guaranteed income throughout retirement. We help our clients with tax efficient planning options, or sometimes we help them realize how tax inefficient their plan is. And so we've put a lot of ourselves into a position where we can help and, to pay it back and to pay it forward. This is the community that I live and work in. I want to support businesses, restaurants, places that are near and dear to our hearts. So here's what we're going to do. We're going to begin this presentation and we're going to touch on many topics, very high level. And it must be high level because every plan is different. Every situation is unique. On the back of this presentation, you're going to have a chance to schedule a 15-minute phone consultation with me. During this consultation, I'll have a chance to learn a little bit more about you, what's important to you, and what secure retirement looks like for you. At the same time, you'll have a chance to learn about me, to ask me questions, and to learn more about what we do for our clients. So we will determine together if we think we're a good fit for each other and if it makes sense to begin the virtual process. So, let's go with a little bit about me. So we're going to go over our goals, the income tax map, deductions, the real tax system. We're going to cover all these topics. All right, so I am Jason French. Okay, I'm an Operation Enduring Freedom veteran and served in enlistment in the United States Navy right after high school. After my enlistment ended, I finished college on the GI Bill at the University of North Florida in Jacksonville. Now, I worked at the bigger firms like Merrill Lynch and Edward Jones, but as I grew in my career, I realized I wanted to offer more for my clients, and I wanted to give them a customized service. And French Capital Management was born in 2015. Now, keep in mind also that I'm a financial advisor, not a CPA, enrolled agent, or an attorney. So the contents of this presentation are based on things I see day to day in my practice and are not specific. It's not specific advice for your situation. So that being said, there is a very practical aspect to taxes. Many of the decisions you make will have tax implications. Whether or not you use a professional to look at those implications is another story. My goal is for you to leave here and have a better understanding of how taxes are different. And, it depends on person to person. We'll discuss the new tax laws and how changes impact many of these decisions that we make every day. And of course, I want to limit the topic today to what is not anyone's belief on what it should be, but rather we're going to stick to what it actually is, not what it should be. Okay, sound good to everyone? One note before we get started, we're going to focus on married filing jointly status. Okay, that's our most common attendees that attend these seminars, but there are other statuses that are out there, but just for, simplicity's sake, we're going to stick to married filing jointly. Okay. So in theory, it's pretty straightforward and extremely similar to the system that we have before the tax reform. Okay, so as you go up in income, the rate the rate you pay also goes up. Now, the new brackets have lower rates at each step, which is why most people are going to pay less under the new system. This tax structure is specific for ordinary income. Okay, which includes wages, most IRA withdrawals, and pension income and interest. Now, this might be an easier way to visualize tax brackets. We call it a tax map because it illustrates the rate at which each additional dollar of ordinary income would be taxed. In retirement, two of the most common sources of ordinary income are pension income and withdrawals from IRA accounts. Notice 0 to about $26,600, there is no tax. That's due to the new, larger standard deduction, plus an additional $2,600 for both of these clients being over the age of 65, which we'll discuss in the next few slides. From about $26,600 to just over $45,000, income falls into the 10% range. Only the income that falls in that range gets taxed at 10%. For the income that falls between about $45,000 and $103,000, that's taxed at 12%. So if those ranges look odd to you, it's because we've included the new standard deduction for married couples, which we'll include later and discuss in the presentation. There are two spots on this map worth really paying attention to. That's because they're big jumps. Okay, do you see them? The jump from about 0 to 10, and again from 12 to 22. And that jump from 24 to 32 are where the biggest opportunities for planning lie. Okay, so this is going to be a fun section right here. Marginal tax rates. Okay, yay. So capital gains and qualified dividends get their own brackets that are separate from ordinary income. These brackets are lower primarily to meet the public policy goal of encouraging investment in the economy. And so there's still a marginal tax concept for capital gains and dividends, but the brackets are considerably different. So here's the question: at what rate are capital gains taxed? Capital gains also have a marginal structure. Okay, notice the 15% capital gains bracket roughly aligns with the ordinary income brackets. So long-term capital gains and qualified dividends that would fall into the 10 or 12% ordinary income brackets actually come through at the 0% rate. The reason is that the old capital gains system was effectively left behind in the new tax bill. We only get up to, say, 15% capital gains rate for the gains that would fall between the 22% tax bracket and the new system. The 20% capital gains rate applies where the old 39.6% ordinary income bracket would have began. So the tax bill didn't dramatically change capital gains opportunities for high income earners. Okay, and also, although 15% is a rule of thumb, it does not hold true all the time. So again, here's a tax map. If you only had dividends and capital gains on your tax return, you would pay 0% until you have enough to fill the 12% ordinary income tax bracket. So for taxpayers in the highest ordinary income bracket, the capital gains tax rate is 20%. This is very important. Okay, it's a very important concept because it shows how capital gain taxation is actually linked to ordinary income. Once the combination of capital gains plus ordinary income pushes you above the threshold, your capital gains become taxable at 15%. This structure really doesn't change underneath the new tax bill, but because of the larger standard deduction, the range at which it impacts you changes. And then this brings us to changes in deductions, exemptions, and credits. These reduce your net federal tax bill, effectively making the first several $1,000s into your household tax free. Now, you can think of deductions as reductions to income for certain things you spend money on. So you can either track those things, such as mortgage interest, investment interest, tax prep fees, and complete a Schedule A, or you can take the standard deduction, which was increased pretty dramatically. In 2017, it was $13,000 for a couple. Now, get this, it's $24,400 for a couple. It's commonly estimated that only about, say, 15% of the population will itemize. For many retired taxpayers, even before the increase, there simply are not enough deductions to warrant itemizing on a Schedule A. Now, once you reach age 65, or if you're blind, you get an additional deduction of $1,300 each if you're married, or $1,650 if you are single. This provision was retained in the new tax law. So what changed? Okay, the personal exemption's gone. Now for 2018, the personal exemption would have been $4,150 per person in the household for 2018. In general, for a couple, the combination of personal exemptions plus standard deductions would have been slightly less than the new standard deduction. Now, deductions and exemptions, they reduce your taxable income, indirectly reducing your tax. Credits, on the other hand, will directly reduce your tax bill. Tax credits are specifically designed to incentivize behavior. Okay, so if you do the government's bidding, then they're going to incentivize that. Two of the most common tax credits are the healthcare tax and the earned income tax credit. Now, a less common one, but one that may be accessed by some people who take a part time job in retirement, is the Savers Credit, which basically incentivizes lower income people to save into retirement accounts. Now, remember, if you've been a high income earner all your entire life, your tax return may be set up to present you as a low earner between the point of formal retirement and the time you're forced to begin taking the required minimum distributions from IRA accounts. So here's an example of a couple that, with $38,000 of gross income, it's all ordinary income. Okay, at least $2,000 of that income must be in the form of wages. First, we reduce the income by the standard deduction for a married couple filing jointly, plus the additional deduction for people aged 65 and over. Then we take off $2,000 for a contribution to a traditional IRA to come up with our taxable income of $9,000. Notice how the deductions reduced in the taxable income. Okay, so we then multiply that times 10%, since all of that income falls in the 10% tax bracket. So for a tax bill of $900, you're doing pretty good right here. Now, remember, credits are different than deductions. Okay, and exemptions. You have exemptions in that they directly reduce the tax bill. So in this case, the Savers Credit results in a $1,000 tax credit, taking the total federal tax bill for these clients down to zero. Why only zero? This credit is non-refundable. Now, remember how our tax map showed no tax up to $27,000? That was the impact of the new standard deduction, plus the additional deduction for age 65 or blind. Okay, realistically, if that were all there was to our tax system, it would be relatively intuitive. But unfortunately, okay, in retirement, we see several complicating factors. Each of these factors you see on the screen creates an environment that affects what you think you're going to pay. So we'll dig into each in this section. Okay, now the first complicating factor is required minimum distributions. Okay, most of our clients have saved pretty significantly into 401k or Roth IRA plans over the years, or just regular IRA plans. Now, generally, these contributions were pre-tax on the front end, so all withdrawals come out as ordinary income. Once you reach the 70 and a half once you reach age 70 and a half, you are forced to begin taking withdrawals. The process for calculating these withdrawals is relatively straightforward. Each year, you're ending the balance for the prior year and divide it by a factor representing your remaining life expectancy. So this is the example of the calculation. Now, in theory, it's pretty straightforward and extremely similar to the system before tax reform. So as you go up in income, the rate you pay also goes up. Now, the new brackets have low rates at each step, which is why most people will pay less under the new system. The tax structure is for ordinary income, which includes wages, most IRA withdrawals, pension income, and interest. So when you think of capital gains, if you're like many people, you think that, that's 15% of the tax bill. Only when I sell something that appreciated, right? Well, not really something to be concerned about. What many don't realize, though, is that you can recognize capital gains even without selling anything, even if you own mutual funds. This is called a phantom gain. The best way to illustrate this is by example. Say mutual fund A bought Apple stock in 1985. You bought the mutual fund in 2014 and then you hold it all the way through 2015. Now, in the middle of 2015, the fund manager decides that Apple isn't really a good investment anymore and sells the entire position. Any gain that was recognized on that sale must be passed through the mutual fund to the current shareholders, even if they didn't participate in any of the gain of the underlying stock. The most important thing to remember about capital gains is that if you have invested non-qualified money, and that's even if you're generally buy and hold type investor, it will likely affect at least some of the capital gains in some years. More importantly, when you experience a capital gain on your return, it can have greater impact than just the tax on the gain because it increases your adjusted gross income and many other deductions or exclusions to be phased out. Now, one of the best examples of the counterintuitive nature of how the RMD structure is with capital gains to create ordinary income is through the taxation of Social Security. Okay, now pay attention here. If all you had on your tax return was Social Security, you would pay no federal income tax at all. But when you have other types of income, you can use your Social Security to become taxable. It's common among advisors to say 85% of the benefits are going to become taxable. Wow. For high income people, 85% is often taxable and 15% is tax free. For the middle and the upper income folks, okay, that is often not true because it's based on a formula called the provisional income formula. Okay, and let me tell you about that. So that can have some strange impacts. Let's walk through how that happens. Your provisional income includes half of your Social Security benefits plus the other taxable income, including dividends and realized capital gains, interest, plus non-taxable interest earnings, such as from municipal bonds. Once we have calculated the provisional income, it's time to apply the thresholds. The key here is that only the provisional income, provisional income that falls for over the threshold creates taxable Social Security. The best way to demonstrate how this works is by example. Okay, so we'll do two examples, both of which have $60,000 of household income. In the first, we have $20,000 of Social Security and $40,000 of IRA withdrawals. We'll take half of the Social Security and add that to the IRA withdrawals, and we come up with $50,000 of provisional income. Then we apply the first threshold. For a married couple, that's $32,000. We're $18,000 over that threshold, and 50 cents of each dollar over the threshold becomes taxable. So we have $9,000 of taxable Social Security there. Now we apply the second threshold, which is $44,000. We're $6,000 over that threshold, and 85 cents over dollar becomes taxable here. So that creates an additional $2,100 of taxable income. Now, we already picked up the first 50 cents of each dollar in step 2, which is why we only multiply by 0.35 here. In other words, even though we have $60,000 of household income, only $55,000 of Social Security benefit is taxable. Now, let's take another example. We still have $60,000 of household income, but in this one, we have $40,000 of Social Security and $20,000 of IRA withdrawal. We can take half the Social Security and add it to the IRA withdrawal to get the provisional income of $40,000. Now, we are $8,000 over the first threshold, which creates $4,000 of taxable income, but we're still under the second threshold. So, of $40,000 of Social Security income, $36,300 is tax-free, and only 10% of Social Security benefits is taxable. When we bring those numbers onto the tax return, you see it a little bit more clearly. The 40K IRA and 20K Social Security blend results in $2,511 of federal income tax. The opposite blend creates no federal income tax at all. So now we've covered the most common ways that create both confusion and opportunity around tax and retirement. Now, these last few things that are higher impact, that impact higher income people primarily, but could also impact you. Okay, if you do a Roth conversion or have a huge purchase. Okay, Medicare is now the means tested, and the threshold is your full Social Security benefit. If you fall over the threshold, you're paying an extra Medicare Part D and Medicare Part B and D premium. In the scope of your total tax bill, it's probably not much, but it's not insignificant either. These premiums are based on your income from 2 years ago, so it's worth paying attention to the thresholds as you consider how much to take from various accounts. Okay, so the 3.8% net investment income tax also applies to higher income taxpayers. It creates an additional 3.8% tax on net investment income, which includes capital gains and dividends, interest and annuity payments, passive business income, and rents. Basically, it's not derived from work or return on your own capital and falls over the $200 or $250,000 of adjusted growth income threshold and is likely to be subject to the 3.8% additional tax. The final distortion, again, applies only for people who have much higher incomes and a lot of deductions. It's called the alternative minimum tax, and it's a flat tax system that runs parallel to our normal tax system. Prior to tax reform, it was estimated that fewer than 4 million taxpayers nationally will be subject to the AMT. Tax reform significantly increased the thresholds and phase-outs related to AMT, so it will apply to only about maybe 200,000 taxpayers going forward. If you are likely to be subject to it, the odds are you would know, and this is definitely an area where a CPA would be helpful for tax advice. Now, the complications that we've just outlined should highlight one major point. Over time, when government has needed new tax revenues, the method has not been to change rates or brackets evenly across all taxpayers. Instead, it's been to introduce phase-outs of deductions and exemptions, or to begin to include income that was previously not taxable, like Social Security benefits. The result is a system in which the most important number isn't necessarily the tax bracket you land in, but instead is the effective marginal tax rate. In other words, how much of your last dollar did you actually lose to federal income tax? Now, let's revisit the map. Remember, as you increase ordinary income from left to right across the bottom, you can see that the rate should be applied to the next dollar. And here is the map for capital gains. Now, let's do a quick case study to illustrate the idea of effective marginal rates. We have John and Jane. They are married, filing jointly, both over 65, both over age 65. They have $60,000 of combined Social Security income, $15,000 of long-term capital gains this year, and a $45,000 IRA withdrawal. Here's their tax map. You can see that once they harvest a little over $10,000 in ordinary income, they begin to experience an 18.5% effective marginal tax rate. That is the point that their ordinary income plus capital gains drags enough Social Security into their calculation to begin making every additional dollar withdrawn from their IRA taxable at 10%, and each additional dollar over that drags out another 85 cents of Social Security into the mix, creating an effective marginal tax rate of 18.5%. You can see that this couple never really experiences the 10% or 12% tax brackets. They go from 18.5 to 22.2, to almost 50% before dropping back down to the regular tax brackets. Now, if you're saying, whoa, wait a minute, that spike occurred at the 12% tax bracket, how did that happen? You're not alone. You're not alone. This couple is in the 12% bracket for ordinary income. You would expect a $1,000 additional withdrawal to create 12% of tax, or $120, but here's what actually happened. The $1,000 withdrawal did not get taxed at 12%, $120, but it caused $850 of Social Security benefits to become taxable, adding $102 to the tax bill, which then together caused $1,850 of capital gains that would have come through at 0% to become taxable, resulting in another $277.50 in federal income tax. In short, on that $1,000, the couple lost 49.95% to federal income tax. Wow. And here is the map for capital gains. Okay, the fact is that there are a lot of ways to control taxes, and to plan in advance is to create a tax efficient retirement. So diversifying among different account types that would have different tax treatment, using tax deferred products where appropriate, blending withdrawals from different account types rather than simply harvesting in sequential order, and paying close attention to which types of investments you hold and which account can make all the difference in the tax efficiency of your retirement income. So today we did a very thorough retirement income and tax diagnosis. I would love the chance to have a one-on-one conversation where we can take a deeper dive into the necessary issues you may have that we didn't cover. All right, so you should consider three things today. Okay, and if any one of these answers is yes, okay, I'm sorry. I'm sorry. I'm not yes. If you don't know the answer to any one of these questions, okay, please give me a call. Okay, that number is 904-479-8843. Okay, so where should my paycheck come from? Okay, you should know that. Am I paying too much in taxes? If it's yes, call me. Will my paycheck ever run out? If it's yes, call me. And now, finally, I leave you with this quote from a famous author, Judge Hand, who wrote the book Spirit of Liberty. Anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the treasury, because there's not even a patriotic duty to increase one's taxes. Great quote right there. So contact us today and you'll receive an email to book your 15-minute consultation. Thank you so much for your time today, and I look forward to speaking with you soon.